thought about. In the meanwhile, I'm going to just discuss those ideas with you. Now, many people have commented that cryptocurrencies or these type of digital assets, I'm talking from the holder's perspective, if you buy a digital currency, right? So many people think that digital currencies like cryptocurrency can be dealt according to one of the following accounting standards. They may be dealt under IS 7 as cash and cash equivalents, be a part of the cash flow, be a part of the current assets balance sheet,
Assalamu alaikum, Sir Yasir. This is Ahad from Lahore, Pakistan.
right? Some people say that, okay, these are not actually cash, but it is a right to receive cash. If you have, for example, if you have a Bitcoin worth $100, you can actually sell it and get cash out of it. So it's a right to receive cash. Some people say that it may be treated under IFRS 9. Some people say, okay, if you have a cryptocurrency, if you have a currency, you may you may get the right to use the platform, or you may get the right to acquire something or use something. It may be treated under IFRS 16. And as I just said, some people say that it should be treated under IS 38. So what the world says, I'm just going to discuss it with you. You see, cryptocurrencies, as far as cryptocurrency is concerned, these do not have legal tender. A legal tender is a legally recognized payment instrument. So for example, if I have a Pak Rupee note, that Pak Rupee note is worth something because the law which is applicable in my country allows that particular piece of paper to be used as an exchange, as a medium of exchange. So since Pak Rupee has a legal tender from the local government, it is valued as cash and cash equivalent. But right now, cryptocurrency does not have legal tender. Now, I really want to clarify it here because some of the people may have some issues with this concept. So you see, cryptocurrency does not have legal tender. It does not have legal tender. It does not have any legal right to be traded as a medium of exchanging goods or services. No, it does not have legal tender. While some companies in the world may allow you to use digital currencies as a means of payment. All of you might have heard that some Starbucks coffee shops and some other countries and some other companies have allowed digital currencies as a means of payment. Even I heard that Tesla allows cryptocurrencies as a means of exchange to get their car. Although some people may accept cryptocurrencies as payment, but they don't have the requirement to do so. Since cryptocurrency does not have legal tender, they don't have the requirement to do so. So legal tender is more of a requirement. It's more of a requirement rather than a choice, right? So since again, cryptocurrency does not have the requirement to be used, it does not have legal tender yet, it cannot be treated as cash and cash equivalents right now. It cannot be treated as cash and cash equivalents right now because it does not have legal tender. Some companies may accept cryptocurrencies as a means of payment, but however, they don't have the requirement to do so. And furthermore thing that IS 7 says that cash and cash equivalents represents anything whose value, there is no risk of significant changes in value. I mean, cash and cash equivalent. IS 7 does not define cash and cash equivalent as euro, pound, or dollar. It says it is a mode of currency. It is something which has a stagnant value. It does not have a risk of significant changes in value, and that is termed as a cash and cash equivalent. But for cryptocurrencies, since cryptocurrency's value is just based on demand and supply, there is a big risk of changes in value. We have seen in past that cryptocurrency markets go down, go up, and they move drastically. So right now, since they don't have a fixed value or a determinant value, or I may say they have a significant risk of changes in value, it cannot be treated under IS 7 because it does not comply with the accounting standards requirements. So cryptocurrency is not IS 7 cash and cash equivalent. So sir, it must be IFRS 9's financial asset. I would say no, because crypto does not provide you a contractual right to receive a financial instrument. I mean, yeah, you may say that, for example, sir, if I buy a Bitcoin worth $100, when I go to a platform, I would be able to sell this Bitcoin for $100, and in exchange, I would get cash, $100 cash in my bank account. But you see, there is not a contractual right that you will get $100. It is just it can be just a matter of seconds that this particular coin turns down to the value zero, and then you have no right to receive cash. All right. So there is a no contractual right to receive cash, which is a pertinent requirement of IFRS 9. So it does not come within the scope of IFRS 9 financial assets. And moreover, cryptocurrencies does not actually form as an equity instrument. Cryptocurrencies in particular, cryptocurrencies is not an equity instrument either, because it does not entitle you towards the residual interest in the net assets of a company. So neither it gives you a contractual right to receive cash, nor it provides you a stake in the issuer's company or the platform's IT company, so to say. So therefore, it cannot be, it cannot be categorized under IFRS 9 as well. Now, you would say, for example, sir, if it is a security coin or a security token, as we discussed right here, now that can be dealt under IFRS 9. You're right. But here, in this particular slide, I'm just talking about cryptocurrencies. So cryptocurrencies whose value actually depend upon demand and supply, it does not have legal tender. It does not entitle you towards a right in the company, in the equity stake of the company. It cannot be dealt with in IFRS 9 as well, most likely. If we talk about IFRS 16, what can be the implications of using IFRS 16? I mean, token holder is provided with the right to use. Once you buy a token, you have the right to use that token on a particular platform. Thus, you have the right to control. You can choose how and for what purpose you use that particular token, right? But I often feel that other requirements of being classified as a leased asset does is not present here. We studied in embedded leases or IFRS 16 that there are 4 conditions that must be met in order to classify a contract or an arrangement as a lease. Now there is an identified asset, and when you buy a cryptocurrency, you have the control over it. But you see, the period of use is actually missing. The period of use is actually infinite. If you buy a cryptocurrency, you can use it for an infinite period, and you don't have to pay on regular intervals. There is no actual, regular consideration involved. And you see, all of the risk and rewards are transferred to the buyer as soon as you buy that particular type of currency. So, for example, if you are an issuer, if you are an YY company, and you develop a particular type of cryptocurrency, you actually coded that cryptocurrency, and for example, you sell it to a particular buyer, all of the risks associated and the rewards associated with this particular type of Bitcoin goes to the buyer immediately. And nowadays it rapidly changes hands. You would sell it to someone else, and this one person would sell it to someone else, and so on and so forth. So you see, so the risk and rewards are interchangeable many a times, and the asset is not going to be returned to the original party anytime. You may say that this type of arrangement should not be classified under leases, right? This should not be classified under leases. It is not a leased asset, so to say. So what are we talking about? What options do we have left now? Yes, majority of the practitioners right now have agreed upon following intangible assets, IS 38, for classifying, measuring, and accounting for these type of digital assets. Now, how does IS 38 define intangible assets? It defines an intangible asset as any asset. I mean, you should control that asset. identifiable, which is non-monetary without any physical substance, meaning being intangible in nature, and it is identifiable. The core thing, if you have studied, I studied it from me, you would remember the main thing is identifiability. No, many of the practitioners have actually come up to the conclusion that cryptocurrencies are identifiable. That is, they can be easily sold. They can be easily sold or valued. Separate from the entity. You know, if an entity actually, if for example, if a platform company or an IT company develops a cryptocurrency, a Bitcoin, they actually code a mine a particular currency, they can sell that particular Bitcoin independent of that entity. So for example, this type of IT company may have $100 million valuation of that particular company on its own, and they can easily sell Bitcoin at $10's value, because it is a product of that particular issuer, not the company in itself. You can easily separately sell and value that type of particular cryptocurrency independent of what the company is worth or what the company is doing. So actually it is identifiable. It is identifiable. It's not non-monetary. It's non-monetary. It's an asset, right? It is without any physical substance. So people say that it should be classified under IS 38. Now, when you do follow the people and based on your own judgment, you classify it under IS 38, you need to follow what IS 38 says. So if you classify it as an intangible asset, IS 38 has two measurement models under its under the standard: cost model or revaluation model. So you need to remember that most likely revaluation model would be applied for intangible assets, these type of intangible assets, right? Because a cryptocurrency actually derives its value based on demand and supply, based on the trading volumes it has on that particular digital platform. So definitely it should be carried according to a market model. So most people would say that, okay, in order to seek fair presentation, we would go for the revaluation model. But remember, if you follow revaluation model, and if revaluation model is applied on one asset, then it should be applied to all assets of the same class. So for example, you may buy different type of cryptocurrencies. You may buy Bitcoins, you may buy Ethereum, you may buy YY coin, you may buy XY coin, you may buy XYZ coin, you may buy different type of coins. But all those coins should be measured under the same model, and that is revaluation model. And now, when you follow revaluation model, any increase in value will go into OCI and accumulated under revaluation reserve. And similarly, a decrease in value would result in having PNL. It would be very easy, I would say, to determine the market value of these type of cryptocurrency as intangible assets, because an active market would always be available. It would always be available. And so you would be following the level 1 of IFRS 13 in order to measure these type of digital assets. In order to calculate the fair value of these type of digital assets, you would be using the quoted price on active exchange, and use it as the basis for fair value, right? So it is, you see the implications of IFRS 13 as well. One thing, you have to follow IS 38, and then one thing more that you should follow for fair presentation, you should follow the revaluation model. If you follow the revaluation model, there you need to calculate the market value, and that market value should be calculated as per IFRS 13. IFRS 13 has categorize the levels that you should use in order to calculate fair value. Active quoted prices is level 1, and you should be using that particular level in order to measure up your crypto assets. Most likely, one more implication of following IS 38 is that most likely these type of digital assets or cryptocurrencies is going to have indefinite useful life. Yeah, I mean, you cannot determine the life of a Bitcoin. Nobody knows. I mean, it can go off tomorrow. It can, at least from the holders or the buyers' point of view, they believe that it will stay forever. So it has indefinite useful life. You cannot determine its useful life, really, right? and therefore there will be no amortization applicable. While there will be no amortization applicable, you need to consider that annual impairment test will be mandatory. So far so good. Many of the people say that when you buy cryptocurrency, when a company buys cryptocurrencies, when Tesla bought cryptocurrency, the most appropriate treatment, not according to me, but many of the practitioners, they say they should be treated under IS 38, right? And you don't only need to know that IS 38 should be applicable. If the marks allow you, you also need to comment on why a particular accounting standard would not be applicable. So why IS 7 is not applicable, why IFRS is not applicable, why IFRS 16 would not be applicable, and why IS 38 would be applicable. You need to talk from various perspectives in order to gain the required marks, right? So, even on a macro level, you should discuss various accounting standards and their implications. At least 5 accounting standards, or maybe 6 if you include impairment testing as well. These have been considered here, right? So 4 accounting standards here, IFRS 13, and maybe the implications of impairment, IS 36 is being talked about here, right? Adding on to this, if an entity holds crypto coins or tokens for sale in the ordinary course of business, for example, you are a platform or an IT company which has the job of issuing, which has the job, ordinary business activity of issuing different type of cryptocurrencies by coding, developing, and issuing different type of cryptocurrencies, then for you, IS2 inventory should be the most appropriate accounting standard. You would not go in IS 38 most likely, but you will go into inventories, the exchange, the platform, the fund that actually issues cryptocurrencies or actually stores, buys, and sell cryptocurrencies in the ordinary course of business would be using IS2 inventories, right? Further, following IS1, you should provide a disclosure outlining your judgments and your estimates that you have taken while deciding on what accounting treatment should be applicable when you hold a particular type of cryptocurrency, and how you have calculated its market value, how you have calculated, you have actually measured that particular type of coin or token. IS1's implication is also there. So many accounting standards that we have discussed, you need to know them all. So overall, 8 accounting standards have an implication when you're dealing with these type of digital assets, right? Good.